Good morning. We're about to start the podcast, ESS BIZTOOLS with Tax Fitness with Darren Gleeson, and we'll be starting in about 2 minutes' time. So if you're interested in participating in this podcast, we'll be happy to talk to you then. If you have any questions you'd like to ask us, can you please send them through to chat? If you're watching this as a live feed on social media, you won't be able to communicate directly with us, but can you just send an email, peter@essbiztools.com.au, and Darren and I will get the answers back to you to whatever your questions are. Okay, so I think we'll get started. I'm Peter Towers. Welcome to Turning Tax into Strategy, the New Advisory Edge. I'm joined today with Darren Gleeson. Hi, Darren. How are you?
Good morning, Peter.
You now?
Good morning, everybody.
We had an interesting webinar a couple of days ago, and the purpose of the day is to have a more roundtable discussion on various issues that are confronting accountants in offering a wider range of services, moving on from taxation. Obviously, taxation is very important for everyone, important for the government that they collect their money, and but it's also important for small businesses that they pay the right amount of tax. As a famous man once said, don't pay the government any more than they are entitled to, but also don't pay them any less. So, Darren, in looking at the overall scene of things, I think a good place for us to start is to look at one of the key statistics that we looked at on Wednesday, and that was from the Intuit QuickBooks SMB Small Business Navigator Report 2025, when they said that only 15% of the small medium enterprises that they interviewed, and they interviewed 500, so it's 75 businesses out of 500, indicated that their accountants had achieved the status of being a top advisor for them, the strategic advisor category. What do you think of that?
I think that's pretty spot on. Over the last couple of years, I've talked to probably 500 accounting practices, and all along the spectrum, probably 80% of them I speak to, they're once a year accountants. So they had, of those 80, they do the annual compliance, but half of them are not even doing an annual compliance meeting these days. They're just emailing it to the client, and maybe a phone call, or maybe not a phone call. So how can you be a trusted advisor unless you're catching up with the clients probably at least quarterly?
I agree.
Okay, and from my experience, probably only 10% of the practices are doing that. And generally, they're going to be, I suppose, the bigger, more developed practices. There's nothing to stop a sole practitioner doing it, but often they just get swamped with the compliance work, and they think about getting that out the door as quick as possible instead of having those meaningful conversations, which we know are the key.
Yes, and you can pick up a lot of issues relating to your client's business by sitting down over a cup of coffee or tea. I preferred having those conversations in the client's premises if I can, rather than getting them to come into an office, because there's normally parking meters, especially in the capital cities and the biggest cities around Australia, that clients then worry about whether they're going to be fined for being there too long. And I think they relax a bit more. And what I found was whenever I visited a client's premises, I come back with more work than I thought I was going to, which...
100%. There's, you can double or triple your fee if you just start talking to the client.
Yeah,
learning about their problems, their dreams, their aspirations, where they want to go, what's keeping them up at night. There's a ton of stuff we can help them with, but we've got to have that conversation.
It's all very important. Now, quite frankly, none of this is new for accountants. 45 years ago, the Financial Management Research Centre was created at the University of New England in Armidale. And it was created not just by the university going out on a limb themselves. It was created with the very strong endorsement, I understand, of the Institute of Chartered Accountants and the Australian Society of Accountants, which is now called the CPAs. They wanted a major university to get involved, and they talked to Dr. Jeff Meredith, who later became Professor Jeff Meredith at the Lismore University. I can't think of its actual title. My apologies to that university. But and one of those key drivers in that original FMRC organisation was Andrew Geddes, who's become a very close friend, and indeed he's my mentor. I interviewed Andrew 2 weeks ago in a podcast, and he said, well, nothing's changed. This was the situation years ago. Accountants needed to, that's why FMRC was established, to try to encourage accountants to go beyond the tax return to help the clients survive. And now, of course, in 2025, we've got a whole section of small businesses in strife, haven't we? According to the Small Business Ombudsman, the failure rates is higher than it's ever been before. Is that a problem for accountants, do you think?
Well, I think 80% of the accountants just putting their head in the ground, and it's not a problem for them because they're not doing anything about it. They're not concerned. The other thing is, in a way, the market is there's that much work, in the economy, accounting work. If you're an electrician, there's electrical work. We've got capacity constraints. So accountants haven't had to, I suppose, in a way, step up to the required plate to make a decent living for themselves. So as an industry, we've been very lucky that there's a ton of work out there, really.
Yeah.
So, I talk to accountants and they got clients, struggling, remortgaging their house, their businesses are failing. A few years later, they disappear. Accountants go, so what? A new client walks through the door. But the thing is, of course, as you know, the effect on the client, even the practice itself, you've lost this business client, relationships, mental anguish, mental health, all that is damaged, and it's not necessary.
Yep, I agree. So, that's setting the scene, I suppose, for what we're going to be talking about today. Is I think it's an issue, and I know that there are certainly some accountants out there concerned about all of this. So where do we start? I really believe that we should start with a business analysis review. I stuck my neck out in an article that I sent to accountants a couple of weeks ago, and I repeat it every year or so, to be honest, over the last 3 or 4 years. And that's to say that you don't know your clients if traditionally you've been just preparing their tax return, because you've probably rarely sat in their office. You might never have been to a board meeting. Do you really understand their internal control systems, their risk management problems, who's got authority to do what? And in fact, that was really proven to me a few years ago. I had been hired by the Oz industry on behalf of the Australian government to run some corporate governance sessions in industrial sort of towns in Queensland. It was in the mining industry mainly they were looking at, and in one of these with about 45 people in the audience, I touched on directors' duties as far as debtors were concerned, and I mentioned debtors' days outstanding. Directors should be observing what it is and asking questions. Was basically what I commented. And a lady put up a hand and said, well, what should the debtors' days outstanding be? And I said, well, what's yours? She said, I don't know. And I thought, oh, okay. And so it was close to morning tea time. So I said, let's have a break. So I went and talked to the lady, and I said, you don't know what your debtor days outstanding. What do you do? Oh, I'm the office manager. Okay. What's the turnover of the business? And it was quite significant. And I said, do you know how much you're owed by your debtors? Oh, yeah, I got the figure here. And she gave me the figure. And I had the turnover and I did a quick calculation. And she must have been watching my face because she said, is it pretty high? I said, it's very high. It was 102 days, debtors days outstanding. I said, who's your accountant? And she told me. And I knew that firm and I knew that guy. Completely coincidentally, 3 weeks later, I was in the town that he was from and I ran into him in a coffee lounge. And he said, I hear you've been out to such and such a town and you talked to one of my clients and blah, blah, blah. And I said, yeah. And he said, yeah, they were quite impressed. And they told me you're going to do a bit of work on their cash flow. I said, yeah, well, they've asked me to, and I'm going to send you a letter. He said, oh, you don't have to do that. I said, I was a bit surprised they had no idea what their debtors days outstanding was. He said, oh, I don't know what it is either. Now, to be honest, Darren, I just looked at him. I said, you didn't know what it was? He said, oh, it's a pretty high figure. I can see that by the debtors ledger. I said, it was 102 days. And he said, well, that's not part of my brief. I'm there to do the tax return. And I don't think that's the right attitude from our profession to be adopting, to be honest. You got any thoughts on that?
Yeah, what he said is correct, and I hear it all the time. I suppose from my point of view is that the deficiency, or probably where he let himself down, is he should have offered those advisory services to the clients. So basically you give them a menu of services and you let them choose whether they just want the tax, or they just want the bookkeeping, or they just want the payroll, or they want the monthly or quarterly reviews and all the other stuff. The whole thing is, with clients, like most people, we can't force them to do stuff they don't want. And as accountants, we definitely don't want to do stuff for free. So
I agree on that.
I'm not in the business of doing all this extra great value work if they don't want to pay for it and they don't appreciate it. So I think if we're in an accounting practice today, we should be offering the clients, the compliance services, which they are clearly, but also different levels and packages of advisory services. Our job, I think 50% of our job, just like 50% of the job for financial planners and finance brokers, all that, is to educate the client.
Yep.
Okay, so we need to educate them on some of the processes to run their business better, some of the tools, some of the software, and some of the advisory services we can provide. And if we're not doing that, I just really don't think we're doing our job, to be honest.
Yeah, I agree. Okay, so we'll move on from that. So the business review analysis, I think, is to understand the client. It wasn't my terminology. It was an American accountant who I'm in communication with, and he used the term an inch wide and a mile deep, and I think that is a great way to describe it. We need to know a lot more about the clients, their risks, their aspirations, how good their leadership team is. Do they need some mentoring and extra training? And being prepared then to suggest that to the client. I had the benefit, I suppose, of 12 years in a public company where I was the company secretary and chief financial officer. I took over from someone who'd only lasted 6 months, and the public company board didn't like him. And I'd met him, and I thought he was a bit substandard, I must admit. But I talked to some of the directors after I got the role, and they said, Peter, never be hesitant in your role. This is a public company. And this was the problem with the guy there before you. He sat on the fence. He wouldn't make decisions. And we saw that as a board. So this was an external director who I'm sure had been nominated by the other external directors to make sure that I was going to be on the right track in doing my role. Now, I thought I was, because I've never been backward in coming forward, but he wanted to emphasize it to me that the board, especially the external directors, we had 3 internal directors, members of the leadership team, but the 5 others who were, 3 others, there were 6 in total, who were the external directors, they wanted to make sure that their chief financial officer and company secretary was going to be honest and not scared, I suppose, of the board process and communicating with them, because they wanted to know that's what I was doing with the chief executive officer as well. Now, I had some real fights at times with him, and I didn't win them all, but at least I made him think things through in a different way. And one time he come back to me about 2 months later and he said, "Remember that discussion on such and such?" I said, "Yeah." He said, "I think you might have been nearly right." That was the closest I ever got to an apology. But I wasn't really looking for an apology. I was just looking to try to get the message across. So isn't that our role to, even for the people we're talking to who are running accounting firms, dealing with SME clients, I don't think we can sit on the fence.
No, I agree 100%. There's a couple of points I'd like to make. I think one issue with accounting practices is they base most of them, probably 95%, they just take on pretty much anybody who walks in the door and they keep them. And what it means is they often end up with, the bottom 10 or 20% of their clients that take up too much time. They're basically not profitable. And if they want to give more deep, lasting connection and advice to clients, they're going to have to reduce the number of clients they actually deal with. For a start, we can't have 3,000 friends. I know practices got 3,000 clients, 5,000 clients. You're going to talk to them about business advisory? You've got to be joking. And then I know some other really well managed practices, they've only got 150 clients. But they're each client's 20, 30, 50, $100,000 worth of fees, and they're all sort of the advisory bit. The other thing is, the second point is about knowing your client. I agree 100%. In the tax fitness software, part of the structure is we've got to understand the client. So, if it's a company or a trust or a business entity, naturally we've got all the details of the assets and income and all that, through the Xero Mobile QuickBooks software. But in our checklist as well, we want to know for the individuals, what's their house worth? What's your super worth, Peter? What's your wife's super worth? Have you got some money in crypto? Where's all the cash, buried and all that type of stuff? And then we've got a complete picture. And of course, we didn't invent that. We just basically copied what, financial planners have been doing for the last 20 years. They've got to know their clients. Where's the insurance policies? What's covered? What happens if, something happens? So the more we know about the client, I think getting that stuff is just 101 to get started. Otherwise, we're just kidding ourselves.
Yep. Okay, well, having done that and understanding who the client is, I think the next big step is a business plan. And I honestly believe, Darren, that a business plan has to be prepared with the management team or leadership team, whatever we want to call them, not an accountant just going, "Oh, well, I'll write a business plan," and off they go to their office and they probably copy a previous one and bring it back. There's no ownership by the leadership team. Then they had no involvement in its preparation. So within the ESS BIZTOOLS system, we're saying, here's the checklist of questions, but you've got to sit down and work with the leadership team to get their answers on these questions, and document that into the form. Is that how you see business plans being prepared?
Yeah, well, my experience is dealing with accountants. 95% of the time, the only time they want to prepare a business plan for a client is where the bank says, "Give me a business plan or I won't give you the loan."
Yep.
Okay. And unfortunately, then they go, as you said, which is the wrong thing. They go to the accountant, "I need this business plan for the loan." The accountant prepares it, a little bit of input from the client, not much, gives it to the bank, put it in the box and forget about it, which is really completely a waste of time for everybody. As you said, the business plan is really the plan for the business for the next 12 months or the few years. And it's a bit like me doing up a plan for your life for the next 12 months or the next few years. I've got to have your input. You're the most important. I'm only helping facilitate it and sort of work together, but you've got to be doing 80% of the thinking. What do you want to achieve? Where do you want to go? How much capital are you prepared to commit? what do you want to do? What don't you want to do? It's a bit like Amanda Gascoigne says with one of her programs for accountants. You got to design the practice that you want for your life. You know, not everybody wants a $5 million accounting practice. Some want 200 grand and, you know, spend more time. And so every client's different. So I think the business plan is critical. I think what scared a lot of accountants off is when we went through uni and all that type of university, all that type of stuff, there was all that thing of, oh, we end up with a 100-page, you know, business plan, etc. But we don't really need that. Often I do business plans for my various businesses, and often they're only just like a 2-pager.
Yeah.
You know, revenue, some KPIs, you know, where we want to be in 12 months, 2 years, and then we review it every 6 or 12 months and works like a treat. But the whole thing is, of course, it makes you think about what you want to achieve and how you're going to get there and all that type of stuff.
Yeah, gives you some goals.
Exactly.
And that leads into what we call predictive accounting reports, the budgets, the key drivers, cash flow forecast, projected balance sheets. At times I see that the budgets and cash flow forecasts get prepared quite independently of a business plan. In fact, about 20 years ago, I had a contract with the federal government for a program called COMET, Commercialising Emerging Technology. And we had to get consultants to undertake the tasks. Our role was to coordinate it all. And I had a client up in the Northern Territory who wanted one particular gentleman to do the business plan and someone else to do the budgets and cash flows. And at the time, I got both of those people together and I said, now, this is all got to be coordinated. So I think the business plan should be prepared first and agreed to, and then the financial interpretation. Oh, yeah, we'll do that. Well, the result I got was completely different. I was like reading 2 different stories. And I got them both together and I said, how did we end up in this mess? Oh, well, I didn't agree with what we had in the business plan, was the guy doing the budgets. And I said, well, that wasn't your request. The client had approved the business plan. And your role was to produce the financial interpretation of the business plan. Do you think that's understood by accountants? Do they accept that that's a role that...
Well, the first question for you, Peter, I'm not sure if you've got any data on it, but what percentage of small businesses actually do a business plan or a budget for the next 12 months? Because I'm actually consulting or talking to 3 small businesses at the moment, and they're quite a decent size small business, $5 million, $6 million, $12 million turnover. To get them to even think about a business plan or a budget or a cash flow is at this stage impossible.
I'm not going to say that everyone's got them. And,
but what do you think? Would it be 10%?
It'd be very, in fact, prepared on the standard that I think is important. It'd be lucky to be 10%, I think. But there are some people that do it. And with the opportunities that are now existent in the marketplace for small businesses to raise capital through crowdsourced funding, equity raising, or early stage innovation company, it really highlights the necessity for proper planning. And so I think it's a very important resource that businesses need. With the growing concept of inviting people to be on boards of advice, I think it's a complete insult to someone on a board of advice if the business hasn't got a business plan. In fact, if I was asked to be on a board of advice, I'll rephrase that. When I'm asked to be on a board of advice, the first question I ask for is the business plan. And if they haven't got one, I say, well, if you want to come back to me in 2 months' time and reissue the invite, I will read your business plan. But if you haven't got a business plan, don't bother coming back. Because I just don't see that there's any way, if you're going to have outside people involved, to say on an advisory board, that they can get anywhere near performing their role unless they have a plan. Because once you've got a plan, you can, we're leading up to benchmarking and all this, but then you can be benchmarking the plan. And I'm I don't know in your benchmarking system if you've really thought about benchmarking what's in a business plan and what's in the budgets and cash flow forecasts. I think that's very important also, because that's really the role, as I see it, of directors and board of advice members.
But it's so ludicrous, really, when you think about small business, because, if I like hiking, so if I'm going for a hike, I have a plan.
Yep.
I at least have a destination, and I have a bit of an idea of, where I'm going to camp, and, I do it. It might not be, a 100-page plan, but I've got a couple of notes, and I've got a bit of a plan. Or same thing if I'm, driving across town to meet someone for lunch. I've got a bit of a plan to get there, but we're running a business which can be our whole life and our whole financial future on the line, and we've got no plan. We'll just get up every morning, do the deed, and then we'll see what happens. It's complete madness,
Yep. Although I have to admit, the public company that I was involved in had been going for 50 years as a listed public company, and I prepared their first business plan after they'd been operating for 50 years. So they'd survived, but I got to see some of the old records after that. There were plans of sorts, but they were not in the formal sort of structure of a document.
But the issue is, they survived, and I think a lot of small businesses, they say the same. We're going okay, we're making good money, and blah blah blah. But the question is, if they had some of these systems, processes, and that in place, whether they'd be a lot more successful.
That's
with
right.
Less stress, less work, less risk, less chance of going bust.
That's right.
That is,
and I think that's the key attribute to them. I think the financial forecasts are important, and obviously there's information that come out of those budgets and cash flow forecasts and business plans that should then be reviewed on a weekly, monthly, quarterly basis, and some of it will definitely feed into benchmarking approaches, I think. The next item I just wanted to mention, we're in conjunction with an American accountant that has been in communication with us, the concept of the 52-week business enhancement system. Okay. What we've done in ESS is adopted what I learned from my experience in a public company, just how a public company operates. And I've since found out that Woolworths, Coles, a lot of the IGA franchises, because I've done some consulting to them, do the same. And that is their whole emphasis is on their weekly results for their various operations. And I think that's one of the huge problems that small businesses have got, especially the ones that are relying on their involvement with their accountant just being built around the tax returns, because it can be months later. In fact, I spoke to an accountant yesterday. It told me he's still got about 100 returns to do for the 2023-24 year.
Oh my God.
Which, he got extensions on. There are some real reasons for that, but and I've got some sympathy for that accountant and his firm. But what about the small business operator?
Well, he's definitely hasn't got time to be focusing on business advisory or worrying about a business plan or a cash flow statement. Not a hope in hell,
Yeah, but then he said to me that some of his good clients are now saying to him, well, it's nearly the end of September in 2025. Where's our June 25 accounts? We want to do things with them. So this is one of the problems that accountants can get into. And I like the idea of weekly performance reports. I saw how they worked in a large company. We had hundreds of businesses, and I don't like the idea of putting everything into one profit and loss account, because I think that can hide a lot of inefficiencies at times and problems. And obviously out of weekly results comes the key data that I think then ultimately flows into benchmarking, and that's key performance indicators or business metrics.
Well, it's like my guru, or my mentor, sort of Peter Drucker. What gets measured gets managed.
That's right.
It's like everything. You want to get fit, you get your Garmin watch out, you measure your heart rate, your distance, all that type of stuff. Same thing with business. It's not that complicated,
And Drucker made that comment many years ago, didn't he?
Well, probably 50 years ago.
Yeah, I'm just trying to think how long ago it would have been, but it's a long time ago.
Yeah, but the old stuff still holds true today. Yeah.
Okay, so we've gone through, I think, the preliminaries, the important preliminaries of setting up a business properly for our accountants and bookkeepers who are watching this this podcast, as to how you might go about getting your clients set up, setting them up for success. Hopefully they'll grow. But then what do we do with this key data that's flowing through? We've got the profit and loss accounts, which we can compare to the budgets. That's a process that accountants in the main do understand. But we've talked a couple of times, key performance indicators, business metrics. You've got a program that looks at then how that information is then compared to other competing organisations. So do you want to just take us through how that process works? How often do people need to do it? What's the preparation process? What's the reports look like? Who are they going to?
Yeah. Well, as you're probably aware, benchmarking, I think, has been around since the 1980s. I can't remember the founder of it, but there was the guy working for Xerox. And back in the 1980s, Xerox, the photocopier people, America, they were getting killed by the Japanese, Fuji and Kachira and all that. So basically he thought, we've got to start improving performance. How are we going to do that? We'll benchmark against the Japanese photocopy companies and that, because they had cheaper products, less defects, superior performance, etc. So anyway, he didn't copy what they did, but he basically started benchmarking their business and all their units. Over time, developed the system, and that was at the start of the whole benchmarking craze. And of course, it's developed over the last 40 years. From Tax Fitness's point of view, about a year ago, we decided to create a business benchmark database, and we wanted to do it differently from most of the benchmarking databases out there. Ours is actually called the top 20% business benchmark, because what we're doing is we're going to benchmark you against the top 20% of the firms in your industry. Because really, what's the point of benchmarking against the 50% level when a lot of those firms are actually failing in business?
Yeah, good point.
It just doesn't make any sense. If we follow the footy, and next week we got the AFL Grand Final, the sides that want to get better, they don't benchmark against the middle. They benchmark against the top, percentage of clubs, and that's what we're doing with this. So we've got 400 or so different industries, and also with our benchmarking database, we're only benchmarking 6 or 7 main KPIs. Sometimes as accountants, we love numbers, and I love numbers as much as the next person, but we get carried away. We want to explain to the client, these are your 100 benchmarks for you, Peter, for your business, when it's just nuts. So most businesses, it all comes down to a couple of main KPIs we've got to keep our finger on the pulse. Cost of goods sold, subcontractors, wages, owner's comp at market rate, net profit, overheads. And it's like in an accounting practice, we're talking to accountants today. They know the number one number they need to worry about is their labour cost, and ensuring that the staff are doing 3 to 4 times that in billings. And then keeping the rent, 6 or 7% of turnover, overheads, decent market rate owner's salary, and then the profit's going to work out 25, 30% of turnover. So we just keep it simple without making it too difficult. The question is how often we should be doing this benchmarking. At the least, we should be doing it annually.
Yeah.
Because really, how do I know I'm performing well for my level of turnover? I look at last year, I look at the year before, I've got this year's profit. Is that a good result? I just don't know until I start comparing it against the top 20% in my industry. Then I can find out, gee, for the amount of hours I'm working, for our level of turnover and the amount of staff, I could be making double the profit with a few little tweaks. Okay. One of our case studies we've worked on the last couple of years, a business $12 million turnover. They were making about 300 grand, which 300 out of 12 million is not a lot of money as a percentage. Anyway, over the 2 years, it worked out. The problem was their subcontractors, 70% of turnover, should have been closer to 40 in the top 20%. We gradually worked with them over the 2-year period, and their profit went from close to 300 to almost $2 million.
Yeah, but the key point that I get out of what you just said is if that SME operator was talking to you as the accountant, and he's got 300 grand bottom line, 70% as contractors. He was probably saying he was happy with that 300,000.
He was very happy because you know what? The year before he made nothing.
Yeah, because he had no separate sheet that you were sitting there and saying, well, hang on, that figure, your major competitors are sitting on 40%, and that changes their bottom line to this figure. So he gets the realization, doesn't he? He says, gee.
Yeah. The whole thing is we don't know what we don't know. And as you said, they were so happy about that 300 grand because the year before it was nothing. And they were excited because, they're employing all these staff and contractors. I've got a big business. I've got 20 or 50 people. I said to them, so what? You built something, but it needs to be tweaked to get the return. And of course, what happened over that time is then suddenly they're making all that profit. Then suddenly they can afford to get a $3 million loan to buy the new premises. And, your life completely changes and not working any harder, just working a bit smarter.
Okay. So you said before benchmarking at least annually.
Yep.
What is your preferred approach, though? If a client said, well, Darren, you tell me, should I be doing it every month or 3 months or what else?
Well, it depends on the, at least annually, ideally quarterly.
Okay.
Quarterly works well because, or monthly. Some of the businesses are actually doing it monthly. My daughter's business, I'll put her under the microscope every month. So we sit down, we have dinner, and we go through it. Doesn't take very long, but the good thing about monthly, of course, is you can start making changes in that quarterly period, and you're on top of things a lot quicker. But for a lot of other businesses, they've got a lot happening just operating the business. So probably monthly is fantastic because it ties in with the BAS cycle as well. We can reconcile everything, and so definitely. Okay.
And out of this process, business improvement strategies are emerging?
Well, that's the thing. In the tax fitness database, of course, we've got the database for business benchmarking. We've got 400 or so different industries, but also we've got the business advisory database, which is 350 pre-written strategies in different categories. So the strategies categories, how to increase sales, how to reduce cost of goods sold, how to reduce subcontracts, that example we talked about. So in that category, there's about 25 strategies about how to reduce subcontractor costs, and they're all pre-written. And each strategy, a bit of an overview of what it's, how it works. And then in the process, these are the 10 steps. And it's a bit like, we talked about, I don't have to tell you, you pretty much, these things pop into your mind. How would we help the client or put them on the path to reduce subcontractor costs? First of all, we would benchmark them against their competitors. Then we'd make sure we got some decent job costing software. All these stuff you actually know, but we put into a format so you don't have to rethink it, and you click a button, have a bit of a read, and you're good to go.
And you're updating your top 20% in each of your benchmarks, every year?
We're updating it every year, but the interesting thing is the percentages don't generally change so much. Unless it's something like a video store, but even that was a slow, 20 years it went from, highly profitable gold mine to, completely worthless.
The young ones could be asking, what are they?
Yeah. Like the profitability of the average accounting practice doesn't jump around 10% a year. It's just, these things move a little bit, but they're fairly tight.
Okay. Righto. Well, one of the other key areas that I think that also should feature in benchmarking is debtors management, and the key figure there is the debtors days outstanding. So is that one of the areas that you're tracking for your clients and looking at these balance sheet items, if you like?
Yeah, we got a ton of stuff about sort of I suppose business basics, and it's just like every morning I get to the office, the first thing I do is I reconcile my zero account. I actually check the bank account, see who's paid and money coming in and out, where the cash is. I reconcile the zero, and you're up to date. And then once a week I look at who's in the debtors, and it's like everything. As Peter Drucker said, it's all about if you want the result, you got to manage it. You know, none of this stuff's difficult. It's just you got to do it.
In our webinar on Wednesday, I shared some of the information that I extracted from Accountants Daily from a former partner in Deloitte who had been an insolvency practitioner, Mr. Sevator. And he really raised the question as to whether accountants were the trusted advisor. What do you think about that category? Is it a category that I'm sure some accountants do earn that title, but
well, I think 10% do. But the question is, if we're not the trusted advisor, where are they getting that advice from? Is it their mate? Is it their parents? Is it the guy at the pub? Is it online? Is it the YouTube video? It's probably not a lawyer. It's probably not a financial planner. It's definitely probably not their finance broker. There's a few business coaches. I don't know. If it's not the account, if it's not us, who is it? You know, to be honest.
Because obviously in that survey that QuickBooks did, 85% of that 500 small businesses were getting advice from somewhere else, because 51% gave the rating as a valued relationship, and that was the accountant was described as not necessarily our go-to advisor. So that's really saying it was someone else, which, if we're looking at financial advice, is rather disappointing, I think.
But it's probably the way with most professions, isn't it? You know, like the old thing about the family doctor for 20 years, and you'd go there and they knew your whole family, and, you know, all that is broken down a lot as well, isn't it? So, you know, that deepness of relationships seems to have disappeared. And a lot of it is brought on by the accountants because they're losing that personal connection with the client as well. You know, if we just communicate all the time through email and me flicking documents across, we need to have ideally those face-to-face meetings, and ideally in their office or their business or our office, or if we have to, through Zoom. But
okay, so I think we've discussed the issues fairly widely and what we've had. If there's anything else you want to add to what we've talked about today?
I think we're in agreement. There's definitely a problem. There's a massive opportunity for accountants for the advisory services. I suppose the other thing we just need to keep mindful of is a lot of accountants have got the capacity issue, so they need to resolve that one way or another. Otherwise, they're not going to have the capacity to provide the needed advisory services for their clients.
Do you envisage that some of the accounting firms will look at this whole problem and decide, yes, well, there is some of our SME clients who are looking for advisory services, but we can't provide it because we're too busy doing taxation orientated work, and they'll be looking for external people to employ who may not have had chartered accounting or public accounting experience, but have got qualifications. They may have worked in larger corporations, both in Australia and overseas. Do you envisage that some of the accounting firms might say, well, we'll set up separate divisions in our firms?
Well, I think some will, for sure. I had a couple of meetings with a couple of accountants last week, and what they said is they're doing over 50% of the fees are in this advisory patch, which is very advanced.
That's very good.
What they said is they got rid of all their small tax clients. They don't take on any I returns. All the small, really, really small micro businesses, they just told them to go somewhere else. So they actually got rid of the bottom to free themselves up. And when I was actually in practice like 25 years ago, I joined with another partner. We merged, and the first thing I did is we, within 6 months, we sold off all our I returns, and this was 30 years ago or 25 years ago, all the business clients where the annual fees were less than $1,000. So we went from about I don't know, 2,500 clients down to about 400.
Yeah.
But it was so good. But what happened within 12 months, we doubled our fees with only the 400, so we could, service them better.
Because you're doing a wider range of services, advisory.
You can't be all things to all men. That's the reality. I talk to accountants, and they've got $25,000, $30,000 a year annual compliance and a bit of business advisory clients, and they're still doing people's iReturn for $150. Like, what the heck? It's like, I don't know. I'm the CEO of Westpac, but I'm still on the teller. It's just lack of delegation.
Yeah.
Anyway, that's a topic for another day as well. But
okay, Darren. Well, thank you very much for joining us on this podcast for our Accountants Minute publication, which comes out every week, and hopefully we've created some discussion points in accounting and bookkeeping firms. And if anyone wishes to, and hopefully they do, follow up with you, do you want to just give them your
there's a couple of things. If you've watched the podcast and you're interested in looking at business benchmarking for your clients, you can actually go to the Tax Fitness website. You can sign up for a free 14-day trial. Otherwise, you can go there and you can book a demo with myself. And thirdly, we've got a 120-page benchmarking manual, which sort of talks about how to integrate into your practice, sell the service, fees, charging, the process, etc., etc. If you're interested in a copy of that, flick me an email at darren.gleeson@taxfitness.com, and I will email you a copy of the manual across. No obligation.
Yes, I glanced through that this morning. There's a lot of information in that manual of yours.
Yeah, there's a lot of stuff, and yeah.
Okay, so, and if any of you viewers want to know more about what ESS BizTools can do for you in our product packages, we don't cover benchmarking. That's really why we're very happy to be coordinating all this with Tax Fitness, and but we have a lot of other information there. A lot of it built around research and development, capital raising, debtors management, corporate governance type issues. So please send an email to me, peter@essbiztools.com.au, or our website's www.essbiztools.com.au. If you would like to be on our mailing list for Accountants Minute, you can do that by going to our website, and you'll see Accountants Minute registration, and that means you'll get the communications each week as we produce them. So thanks very much, Darren, for being with us today.
Thanks, Peter. Appreciate the opportunity.
I look forward to catching up with you again later in the year, and we'll keep people informed of what's going on. And hopefully this support from SMEs will improve in this key strategic partner category. I'd really like to see that go from that 15% to at least 25% by the next time. And I think our aim as a profession should be, we should have that up around 80%. And but that is going to mean that a lot more advisory service work is done, I think.
Agreed, 100%, Peter. Thanks for the opportunity.
Thanks, Darren. Talk to you later. Bye-bye.
Bye.